Thank you very much for joining us. My name is Dan Coatsworth. I'm a stock market analyst at AJ Bell. Now, there's a investment disclaimer for you to read through. So the highlights are that we do not offer investment advice. So if you're unsure about the suitability of any investment, we recommend that you seek qualified, independent financial advice. So I'm gonna talk about reasons to be positive about the UK stock market, and I don't think we could have timed this webinar any better. It's been a fantastic week to talk about the UK stock market. The FTSE's hit record high. We've today just had the second takeover approach for a FTSE 100 company this year. So lots talking about. I will, cover some key themes here, and they might come up in some of the other presentations that we have as well. So, but there's some important things to cover. One is obviously cheap valuations. I think you have to be living under a rock if you don't realize that the UK market is so much cheaper, particularly relative to places like the US. I'm going to cover a little bit about the broad range of industries that you could find. M&A, mergers and acquisitions, or which is jargon for takeovers, lots going on there. And there's a little bit of stuff to talk about. I think it's quite interesting to make some observations about foreign investors. Lots of people, perhaps turn their back on the UK market when the Brexit vote happened in 2016. They're unsure about the outlook for the country, about the economy. And then we had lots of political uncertainties. It just feels like that might be turning as well. So, and then I wanted to quickly cover the UK ISA launch. But I think some of these topics we'll go into perhaps in more detail, either in the individual fund manager presentations, or we can cover them off in the question and answer session. The first thing is, I wanted to perhaps just cover what you can get on the UK stock market. I think that loads of people just, they talk about, the UK market, they say, oh, it's just full of banks, it's just full of mining companies. And it's not quite the case here. And you can see the sort of the breakdown on your screen about the FTSE 350, which covers essentially the 350 biggest companies on the UK stock market. So it's the FTSE 100 and the FTSE 250. Lots of industrial companies on there, lots of consumer-facing companies. So that's whether that's obviously on the staple side, so things that you need, like your shampoo and your deodorant sort of supplies. And then you've got discretionary things like whether that falls under sort of DIY companies or retailers. Lots of financial companies on there, but that's not just banks. It's actually insurance companies as well in there. So we do have some big names like Legal & General and Aviva. There's 26 real estate companies in the FTSE 350, and this is all excluding investment trust, but they don't really take up that big a chunk of the market. But the one thing I wanted to point out was basic materials. So if the assumption that we've got, everyone says the UK market's full of mining companies. It's not the case. Basic materials covers miners and packaging companies essentially. Well, DS Smith is one of the big packaging companies, and it's in the process of being taken over. So that representation of basic materials is going to shrink. Anglo American, which received a takeover offer from BHP today, also would sit in the basic materials sector. No guarantee that actually, this offer is going to succeed at all, or whether we might have someone else bidding. But I just want to make the point that the index is not perhaps constructed as some people would suggest. The only thing that is fair to point out is that the technology sector is woefully underrepresented on the UK market. And I think this is why lots of people have been looking at US shares for quite a while, because that's where you find tech stuff. It's where you find fast growth names, particularly if you want to play AI, this is the natural place to look. But I would argue that the UK has a really important role to play for investors who look for perhaps more boring companies, because boring can be beautiful, and I'm going to come to that point in a bit. And there's some really decent businesses here that quietly just get on with the job. They grow profits, they grow dividends, and there's lots of opportunity. So we'll go through some of those as in this presentation. So takeover premiums. Takeovers are a big thing that's been happening in the last few years. The UK stock market is cheap, and lots of people are cottoning onto this, whether that's private equity companies looking to do deals, or it's industry players looking to buy someone else. So on your screen, you can see the average premium that they paid versus the market price just before that bid was first announced. Last year it was 51%, so they paid 51% above the closing market price on the trading day before the offer was made. That seems pretty generous to me. I always thought, if you go back in history, I always thought it was about 20–30% for a bid premium. 51 is very good, and it sort of implies that some of these bidders are very serious. They're coming in and saying, we recognise that these stocks are trading cheaply, but we also recognise we don't want to be too cheeky with what we're paying. We want to give you a fair offer, and I think that's perhaps what's recognition of that in those quite big premiums. Looking back on what was popular last year in terms of why these takeovers actually happened, there's some key common themes. One is geographic expansion. I got a really good example. There's an American firm called CoStar, really big in the property space. It bought On the Market, the sort of the property portal, essentially as a way to get a foot in the door to sort of conquer the UK market. And it's going to, and of course, its big opportunity there is to sort of take market share from names like Zoopla and Rightmove. And you just have to look at Rightmove's share price since this takeover deal went through. The market's worried that Rightmove now has a serious challenger, because whilst On the Market is tiny, having CoStar as its new owner means access to significant pools of capital. Balancing on share price weakness and taking a long-term view, some of those are sort of interconnected. And I think a good example is Hotel Chocolat. So Mars bought the company. Hotel Chocolat was going through some, it didn't quite work out with some of its overseas expansion plans. The share price was really weak, and Mars came along and said, look, whilst we can see some issues now, long term, we think there's a really good opportunity for us to be the natural owner of this business. But then you've also got things like companies that have been struggling, and as they try and recover, sometimes there's bumps in the road. It's perfectly normal, and you get setbacks, and sometimes you just get someone that comes along and says, I actually think this company would be better out of the public spotlight. So we saw this with the restaurant group, the owner of Wagamama. We had private equity come along and say, look, we'll take you out of the spotlight, we'll give you support, and we'll let you properly get back and get back on your feet. So these are common themes that I think happen. And then, at the end of last year, I was thinking, well, all of these are sort of involving smaller companies. Imagine what would happen if interest rates start to be cut. Borrowing costs are not so high for bigger business. Could we see some bigger takeovers? Well, yes is the answer. DS Smith takeover suddenly set things going earlier, and of course today we've got this Anglo-American approach. I think that there's, it does raise some questions about. There's still lots of companies on the stock market which are looking pretty interesting in terms of takeover potential. Now, some of the deals we've already seen happen, they haven't necessarily gone through, but Wincanton, Spirent both had lots of bid interest in them. Redrow as well. Virgin Money is going to be gobbled up by Nationwide. Now, Currys and Superdry, they're not, they're in a sort of slightly different situation. Currys has fought off bid interest, still sticking on the stock market. Superdry is on its last legs. I think it's basically come out and said we need emergency funding, and we really can't. Part of that is condition is just get us off the stock market. So just because a company's had a takeover doesn't necessarily mean it goes through. Equally, one of the things that I have been seeing is that lots of investors are sort of saying, okay, you've offered me a generous bid premium, but it's not enough. If you're really serious about buying this company, you've got to pay up. So we've seen quite a few takeovers where the bidder has actually come back with a higher offer after getting pushback from the target shareholders. So that's something for you to consider if something in your portfolio receives a takeover bid. Don't necessarily think that the first offer is the last offer. How about potential takeover target names? I think there's 3 names to me which have got the type of qualities which make them vulnerable. Reckitt's share price is I don't know, it must be 12-year or something like 13-year low at the moment. It's been battered because questions about whether it's made some poor decisions with acquisitions. It's also embroiled in sort of legal threats around one of its products. Diageo, again, I think it's sort of taking its eye off the ball a bit. We've had some problems with, not understanding how much stock is kicking around in Latin America. Some question marks about whether it's got the appropriate management team at the moment. And Dr. Martens has just had a really tough time. A great brand. And if you look at the returns it's made on the money it's invested in the company over a longer term, it's pretty good, but it's just had lots of problems in the US recently, and share price is incredibly weak. And of course, like I said before, share price weakness is potentially a key red flag for a business to receive a takeover offer. UK ISA, I mean, obviously this is something perhaps we'll talk a bit more about in the Q&A session at the end if people watching the webinar would like to learn a bit more about it. Just in a nutshell, government's come out and said, we'll launch another ISA. You can get an extra £5,000 allowance on top of your existing £20,000 allowance, where any gains will be free of tax, any income you get will be free of tax. So there's a question mark, is it enough to attract attention? I would argue that lots of people don't actually fill up their full ISA allowance, £20,000 allowance, anyway, the existing allowance. So there's plenty of opportunities to put it into UK stocks or UK related funds already. Do we really need another ISA? We've got enough of them already. It's all a bit complicated, but you can never say it's a completely bad idea. I think it will, and it already is shining the spotlight on the UK market. There's a consultation with the industry that runs from April until June. So once that's happened, we'll get some more information and get proper definition of exactly what you can put into these ISAs. So maybe one we can pick up a bit more in the Q&A session at the end. Now, on your screen, I wanted to give you an example of some names that have done very well. So this is since the ISA was launched 25 years ago. We've got some fantastic names here that delivered very strong returns. This is proof that you don't need to just only go to the US stock market to find things that will make you money. There's plenty of stuff on the UK market. The one thing that always it made me chuckle when you look at the information and you realize, God, there's one thing common here. These are some of the most unglamorous companies you can imagine. Diploma does widgets for factories. Clarkson's a shipping broker. Antofagasta's copy miner, but arguably it's digging in the ground in Chile. Hill & Smith does crash barriers. Games Workshop makes little toy trolls. Howden Joinery does bits to make kitchens. I mean, these are they're boring, but look at the returns that they've made for investors over the years. They're experts in a market niche, and I think that's the key point here. The UK market is absolutely full of brilliant businesses that are experts in a market niche, and I think that it's very easy for people to sort of make sweeping statements about saying the UK market is boring, full of old economy stuff. Plenty of good stuff in there if you have a dig around. That was over 25 years. This is over the past 5 years. At the top, you've got the best performing FTSE 350 stock over 5 years is Premier Foods, makes Mr. Kipling cakes and things like Oxo gravy granules. Not glamorous, but it's quite interesting stuff here. So Games Workshop's made another appearance there. You've got BAE Systems, the defense company, Ashted that does construction equipment stuff. So it does go to show that there is some really quite interesting things here, and it's not all just about tech stuff. Now, what's working this year? This has a look at the first quarter of the year. Telecoms equipment is right at the start. Actually, that's only Spirent, so that's to do with the takeover. But if you look below that, Rolls-Royce continues with its sort of recovery, and Babcock seems to be sort of getting its act together after some patchy period. With the insurance stuff, Direct Line also seems to be getting back on its feet. 4Imprints on there. That company makes promotional pens and hats. Again, not glamorous, but show a business that is very good at what it does. Compass is a catering company, has delivered kind of decent returns. And don't forget, you'll get these slides sent to you, so don't worry about if you're trying to scribble down some names just to have things to look at. So I guess the big question is, I'm sort of giving examples of what's doing well in the past and more recently, and saying that there's opportunities. But what is the track record? Well, on your screen, you can see how the UK market compared to the US over the last 10 years on an annual basis. Now, yes, there are plenty of years where the US has done better, but the ones in the circles are the couple of years where the UK market is outperformed the US. There's a couple of things I want to say. Is that, look, the UK market can be quite resilient in a downturn. Actually, I was just looking at data for today's trading activities. The US stock market is down nearly 2% today. The UK market is up. It goes to show that they don't always move in tandem. So when things are going not very well over the sea, across the pond, people sometimes look at the UK market and it's actually more resilient than you think. And if you look at some of these other individual returns for the UK market, the bits in blue, you've got 2021, 14.3%. That's a very good showing. If you think that historically you might make 7 to 10%, a very good year for the market. 2019, good return. 2017, good return. 2016. And I think that when we're seeing some cracks in the US market. So at the moment, the Magnificent Seven group of big tech companies. Tesla's had a terrible year in the stock market up until a little bounce back this week, but Meta is down 12% today. We got results tonight from Microsoft and Alphabet. Let's see what they do. So, and names like Apple are finding life harder. It's in these situations where investors might look back at their portfolio and think, okay, well, I might have done well in the US, but how diversified am I? Might I think about some of the markets that haven't done well? Maybe it's time for the baton to be passed, and maybe it's their opportunity to sort of shine. So this webinar will feature 3 investment trust managers. So if you don't want to pick individual stocks, the other ways that you can get exposure to the UK is via investment trusts, funds, or ETFs. So on your screen, you can see there's a few examples of the different types of investment trusts you can find. So Mercantile is one of our speakers tonight. I think the beauty about it, if you're looking to play the UK, and you can actually find sort of different styles. So you might just want to have certain size companies in the UK, or ones that have more emphasis on dividends or value stuff, or smaller companies. It's the same with open-ended funds as well. So you can have names like Lion Trust UK Growth, kind of does what it says in the tin. Martin Currie UK Rising Dividends is an example of one of the many funds that has an income tilt. But these are all run by fund managers, actively managed funds. But if you don't want that, you could look at tracker funds. Again, you can find, there's some examples on your screen here. Amundi Prime UK Mid and Small Cap ETF. It's not hard to understand where they're focusing here. And I think this is the beauty of the sort of the fund industry, that it has sort of matured enough that we don't need to just get one simple FTSE 100 tracker. You can get a bit more specialist focus if you want it. So I guess the key question here is the UK is cheap. It's been unloved, but what will make it different? And I think that the FTSE doing very well, hitting record highs is a good start, but it's not the only thing that we need. There's suggestions that perhaps if we got rid of stamp duty on shares, that would certainly help. The government is looking at different ways that it can perhaps make it more attractive for companies to list on the stock market. And I think we need that as well. With all these takeovers, and also we've got a trend for companies perhaps to look at the US to see if we can get a higher valuation, shift their primary listing there. If there's suddenly, that implies a shrinking market for the UK. Are we replenishing that pot? At the moment, the rate of IPOs is pretty slow. So the answer is definitely no. So we need to find out how can we get more companies to list in the UK. So there's lots of work that can be done on sort of policy side of things. But I'd like to pose that question to our other sort of fund manager guests tonight in our Q&A session. So that's all that I'm going to be covering in this bit. So what we'll do now, we'll bring on each fund manager one by one. They're going to talk for about 20 minutes each. Keep sending in your questions, please, and then I'll collect them all. So we've got three sets of 20-minute presentations, and then we'll do a 20-minute Q&A. So let me now say thank you very much for listening to my quick run through about why the UK market is got lots going for it, even though there's lots of negativity around it. I think that there's definitely reasons to be positive.